Greetings, friends. This is Erwin Cito, and welcome to the Truth About Real Estate Investing show for Canadians, the now number 9 ranked podcast for Canadian investment and personal finance per FeedSpot. Thank you, listeners and past guests of the show. Couldn't have done it without you. As always, it is an honor to have this platform and an ability to give back to the community, and that has been so much. That's meant so much to my family and I, where we get to share. We all get to share our passion for the best investment class in the world, which is real estate. Here on the show, it's my job to interview the top minds in real estate investing and business to uncover the strategies, mindsets, and habits that actually work, especially in today's historic market. This week's guest is Scott Dillingham, founder of Land City Mortgages. He's returning to the show with a mortgage market update. He is a rare expert in both Canadian and U.S. real estate financing. Scott built his career helping investors, starting as a high-volume mortgage broker at one of Canada's top Big Four banks. He worked there for 10 years, where he consistently ranked among the top 1% nationwide. In his peak, he actually closed 410 mortgages just by himself, and almost all of them were investment properties. He's also a seasoned real estate investor himself, owning dozens of rental units, which gives him firsthand insight into the challenges his clients face as Ontario as real estate investors. And note that he supports all of Canada for mortgages. What makes Scott especially unique is that as a dual citizen, he's able to own and operate mortgage brokerages in both Canada and the US. Something rare. I personally don't know anyone else who can do that. That means Canadian investors working with Scott can access both lending strategies, mortgage approvals, both for home and investment, and support for properties on both sides of the border, all under one roof. Through Land City, Scott's works with over 60 lenders in Canada and 2,500 lenders in the States which are meant for non-residents of the United States. That includes Canadians. And that's the way that he can help investors scale smarter, no matter where they're buying. Now you can catch Scott live Saturday morning, April 26th, at the half-day iWIN meeting. We have in-person seats, which are almost sold out, and a bit of room online for all of those who want to. So for those who live a little bit further away and want to zoom in, we survey our subscribers, and according to our survey respondents, you want to hear more about landlord-friendly strategies such as student rentals, short-term rentals, and of course the USA. And that's what you're going to get. My team and I will be sharing local real estate market updates, including rentals, tips on selling tenanted properties, and Scott will be live and in person, where he will share the best practices on financing and navigating both Canadian and U.S. lending markets. Registrations in the show notes. For those who are able to write this down, iwinmeeting.eventbrite.ca. Again, that's iwinmeeting.eventbrite.ca. Again, that's in the links in the show notes, so you don't have to crash your car while driving and listening to this show. And please enjoy the show. Before we get to our guests, I want to take a quick second to share something valuable with you. If you're serious about building wealth through real estate but struggling to find profitable investments in Canada, I've got something that will help. I've put together a comprehensive guide to U.S. real estate investing for Canadians, breaking down the best markets, financing strategies, tax considerations, and landlord-friendly states where Canadians are getting better cash flow and long-term appreciation. It's completely free. You can grab your copy at www.truthAboutRealEstateInvesting.ca. Just look for it on the right side of the page. Along with the guide, you'll also get our weekly newsletter that goes out to over 10,000 Canadians at no charge since 2010. Yes, I've been sending it for every week since 2010. We send new podcast episodes as they're released, so you never miss out on these expert insights, invites to exclusive in-person and online events with top real estate minds, actionable strategies to help you grow your portfolio and build wealth faster. Again, go to www.truthAboutRealEstateInvesting.ca and download your free guide today. Now, please enjoy the show. Hi, Scott. Thanks for coming on the show.
Yeah, no problem, Erwin. Thank you so much for having me. Really appreciate it.
Oh, and then I don't know if you saw, the show actually just ranked 9th for in the top 60 for investing in Canada. So I came second to only one other real estate podcast, and the other ones are all about stocks and financial planning. So Pretty proud of that.
Good for you. Congrats.
Yeah.
Congrats. That's awesome. So we'll have to see what they say when they find out that you've been talking a lot about the States and see if that changes
Oh boy.
where they rank you.
We'll get into that in a minute. Like for the listeners' benefit, can you talk a bit about your experience in mortgages, and so they understand why they should be listening to you?
Yeah, absolutely. So I started off as an investor first, and I was struggling to get my own mortgages approved because the representative at the bank, they didn't understand because my portfolio had grown to, beyond where they could fathom. And I was helping them to do the application. And I'm like, this doesn't make sense that I'm helping the lender do the application. So then I said, you know what? I want to do mortgages now. And then I did. I got into it, and my focus the whole time has always been investors through the ups and downs and high rates and all that good stuff. And then, as you know, I'm going to call it maybe 2 years in total now. We've been in the States. So we're doing Canada and the States. So it's super cool, super exciting.
And for the listeners' benefit, how many years did you work for the bank?
This is 10.
10 years you were at the bank? I didn't know it was that
Yeah,
long.
I
And you
know.
were you were the number one. How many? I know for 1 year you were number one in volume for all of Canada at that particular bank.
Yeah, yeah. So like consistently year over year, I was top 1%. And then my last full year, I did finish two. I did a lot more units than the guy who got number one did, but the guy who got number one lives in Vancouver, where their average mortgage is 1 million, where I'm in Windsor, which at the time the average loan size was like 200,000. So he outranked me. One of his loans is equivalent to my five, but I beat him by units. So I did 410 that year.
And then to like, I always believe there's everything. There's everything. There's so much to context. You were on your own. You had no team. You had like
Yeah.
an assistant.
Yeah, well, I had two, and I think that was the tipping point because they told me like, so I had one, okay, so a bunch of people had one, that was fine, but I was the first in the country at the bank at the time to have two. So their payroll system was not set up to support two assistants. So then when I went to three, they're like, "Whoa, Scott, you're breaking our systems here. We can't even handle this." And I said, "Well, I need a third because I have no life. Like I was only doing mortgages. I did
Mhm.
nothing else. Like seriously, woke up and went to bed. I did mortgages all day. I had to just to maintain it. So then I started Land City, so then I could branch out, grow the team, and now we have 22 people.
Yeah, so you have a lot more people than you used to, like
Yeah.
7 times more people. So Scott, this is a question that pretty much every real estate person out there wants to know, both investors and just even regular homeowners. What are you seeing in the mortgage market right now? Both, let's start with Canada, and then we'll talk about the U.S.
Yeah. So Canada, Canada's a bit different because I'm actually really excited for Canada. I know there's a lot of pessimism, and I think a lot of people are scared with what's going on with potential tariff wars and things like that. But the thing is the rates were really high for the past 2 years, and there's lots of buyers that are on the sidelines, and they were waiting. They were just waiting for the rates to come down. And at the start of this year, I remember telling everybody, I'm like, this is the turnaround year. Like, this is when all these pent up buyers are going to come out and they're going to buy, and the market is going to completely recover. Right. And then tariffs and all that came out. But so what you're seeing is you're seeing the demand is there, but people are on the sidelines. But you are seeing rates come down slowly. So I really believe once the tariff thing kind of washes out, and obviously upcoming elections and stuff, depending when this gets released, maybe the election already happened, but if not, right, that's still pending. So I think it depends, but I think if it sizzles and nothing's crazy, I think you're going to see a ton of buyers come out that have been waiting. So I think the market, like the potential's there for the market. But yeah, rates are absolutely coming down. The bonds are coming down, which means the fixed rates are coming down as well. And then the Bank of Canada should be lowering the variable. We do have to keep in mind inflation, right? Because they are watching that too. If inflation goes up, then they're going to raise the rates. So we got to kind of watch that. But so far, everything is sort of still trending down a little bit. So that's kind of where we are in Canada.
Can you talk to maybe what was like the buyer sentiment like the last 6 months or so? Because you speak to lots of them since you find them their cheap money.
Yeah. Well, I mean, there's two classes, right? There's the investors and the homeowners. So, I mean, the investors are like, we're getting ready. This is awesome. Rates are coming down. We're going to move forward. Um, and then same thing with the homeowners. They're getting pre-approvals early. So that way they're ready to take action. So there's so much demand, but because of the uncertainty, right? People are on pause. But I think if I was to really break this down, I think more of the homeowners are on pause. I see less homeowner deals like running through the system, and I see an increase in investor deals because the investors are looking at it like, yeah, this tariff war, it's cooling certain real estate markets. This is great. It's a better time to buy, right? When prices are going down if you're an investor, right? Because you can ride the wave back up. So I'm seeing a little bit of that shift where homeowners are a bit on the sidelines and investors are a little more willing to come out now.
What are interest rates like today, and where do you think they'll be at by the end of the year?
So in Canada, if it's a home you're moving into, you're looking at high threes, which is very reasonable. For rental properties, you're looking at low fours. And again, that's Canada. Obviously, if you're buying apartment buildings, it's even lower than that, depending on the size of the loan. But for regular properties, 1 through 8 units, those are kind of where the rates are. Now, where they're gonna be, there was a great chart which just came out, which outlined it, but pretty much the big banks are anticipating the variable rate is going to drop 0.5% more than now. So right now, today, prime is at 4.95. And that 0.5%, sorry, let me rephrase it because tomorrow is the 16th of April, which the Bank of Canada is also supposed to lower 25 basis points. So we're talking an extra 50 on top of tomorrow's decrease. So about 75 basis points in total for the variable. The fixed, there's no control over it. It's tied to the whole market. So we'll have to see, but they are anticipating the fixed rates to come down maybe 1/4% to 0.5%.
Mhm. I think the generalization is the worse the economy, the lower the long-term rates will be. Is that fair? Is that accurate?
Essentially, that's usually how it works because they lower the rates to stimulate the economy. But the challenge also becomes, because of the tariffs, is the strength of the Canadian economy. Because if the global investors, and when I say global, I mean, institutional banks in other countries or other countries as a whole buying Canadian bonds, if they feel that Canada is going to be really damaged by the tariff wars, then they won't move forward with buying the bonds. But if they feel that Canada can weather the storm and they feel strongly about it, that could actually raise the fixed rates, even though the economy could be cooling. So it's a bit of a unique scenario we're in.
I think for years I've been saying we live in historic times, and then this guy was elected a few months ago. I've
Yeah.
never seen anything like this. I don't think anyone ever anticipated anything like this. Anyways,
No.
let's talk investors. Has anything changed for investors for financing, say, their next property, both
In
in Canada
Canada?
and the US? Yeah, let's start with Canada.
Okay, so Canada, not really. It's more income based, right? They are going to look at your personal income and see that you qualify. Certain lenders, and I'm not going to name their names, but there are certain lenders where if your income is from a job that they think might be affected from the tariffs, they're not letting you borrow at your maximum debt ratios like they would have before.
Hmm. Hmm.
So that can actually hinder, even if it's a regular homeowner, it doesn't matter. That can hinder a mortgage client if they're in an exposed industry. So,
Hmm.
like if you work for automotive, if you work for construction, there's a few others, right? If you
Hmm.
work for the aluminum industry, right? Stuff like that, they're anticipating a slower demand. So they'll still lend to you, but not as much as they would have. So you want to be careful with that.
Hmm.
Um, does that answer your question?
Yeah, my first thought is also as well as that listeners should be paying attention to which industries because they should be paying the same attention to when they're screening for tenants.
Yeah,
And when they look in
absolutely.
their own portfolio, when they look at what industry their tenants are in, that I've already reached out to all my tenants, so I think that would be wise for all landlords to be reaching out to their tenants, especially the ones who are exposed to tariff risk.
Yeah, I'm gonna see. I'm just pulling it up real quick here. I can't share the screen and show you the lender's details because it was an internal memo, but I will see if I can find it and read off the industries here that they're concerned with. So let me see here. Okay, got it. So they're calling this limited appetite industries. So what they're saying is,
That's explicit.
yeah, so they're scaling back the debt ratio. So if you're in construction, transportation, leisure and entertainment, retail sales, banking and finance, which is funny too, manufacturing, farming and natural resources, wholesale trade, utilities, and steel and aluminum. So if you're in any of
Utilities?
those industries, yeah,
Utilities?
yeah, they're scaling back.
Who doesn't need utilities?
I know, but I think that one, and I could be wrong because I didn't make these rules, but I think that one is because like you look at certain things out there and people are trying to go green, right? So if you're not green, like say you're an electrical company, right, and you don't have green, that could affect your jobs as green energy comes. I don't know. I might be wrong. That's how I interpreted that though.
Fascinating. And has this come up? Has this come up yet? Has any of your clients actually been subject to these rules?
Yeah,
Oh,
yeah.
damn.
Some have come up. So you gotta be careful with it. And not all lenders are doing this where they're scaling back, but
Yeah.
it's happening, and I can see maybe more doing this. So you never know, yeah. But this was effective March 19th, so it's been out about a month.
I just go out and say it then. That's part of the benefit of going to the States because they don't even look at you personally.
They don't, right? It's cash flow, and that's why I know we're going to talk about it here, but that's why multifamily in Canada is really cool too, because they're looking at cash flow. But I agree with you on the States. There's just a lot more opportunities as a whole.
Has anything changed in the last few months or so for financing in the States? Other than I know you've onboarded even more lenders, which is only a
Yeah,
benefit to our Canadian investors.
oh, it's crazy. Yeah, we have over 25,000 now. It's just insane. It keeps growing. Um,
Oh, sorry. For context, how many lenders do you work with in Canada?
so in Canada, on our disclosures, it says something like we work with like 60. Um, and I know like there's definitely a few hundred. Like there's definitely a few hundred out there. And when you count private lenders, I mean that number grows, drastically. But these 25,000, like that's not including private lenders. These are like institutions, trust funds. Like it's like, yeah, it's massive.
Fascinating. And then has anything changed much on the US side for investors?
Over there, some of the changes that I'm seeing is, and I don't want you to think that this affects really anybody because there's so many lenders that it really doesn't affect anybody, but just the trends that I'm seeing some lenders no longer do foreign nationals, which is what a Canadian is. And I think that's just because they're uncertain of what Trump's going after, right? Because Trump doesn't want foreign ownership of things. He wants domestic ownership. Um, so we're seeing a little bit of that. We're seeing some lenders pull out of markets where the loans could be quite small, or overly flooded or don't have a lot of stuff going on. So,
Mhm.
for an example, Ohio, there are a bunch of lenders that have come out of Ohio, or they've increased the minimum loan amount that they're offering. And guys, I mean, do your research. I'm not saying Ohio's good or bad. This is what I'm seeing. And it's not just Ohio. There's a few other markets there. I'm just mentioning Ohio. Um, and then on the commercial world, so there's three tiers of lending in the States. And I'm gonna let people know more in your in-person events. Okay. So I don't want to spoil all the details, but there's three tiers. So there's DSCR, which is what people primarily know and what they flock to. And then there's CMBS loans, and then there's agency loans. So agency is the equivalent of CMHC for multi-family buildings here. That's your Freddie or Fannie over there. So the CMBS loans are at risk in the States. So there's a lot of multifamily properties that are coming up for renewal this year. And when those investors renew, the rates are going to 3 times to 4 times. So they're thinking that there could be some extra foreclosures this year. They're thinking some of the smaller banks might go under, right? Depending on what their holdings are. Um, I think it creates a great buying opportunity. But with that being said, what they've done is a lot of the lenders that do the CMBS loans, they've scaled back their loan to value. So that way, new loans, they've got more skin in the game to help minimize the damages of that. So I've noticed that too. The LTVs have increased is the response there.
What happened to these properties that they're having this kind of difficulty?
Well, think about it. Like, say you've got 1.5%, Erwin, and you've had this forever, right? And you've
Oh, yeah.
over leveraged yourself, right? Because you're growing your portfolio. So now you're over leveraged. You might still be cash flowing, right? But then now the rates come in at 6 to 8, right? Depending, let's just say that's where they come in, right? So now your payment goes up 3 times. So maybe you had cash flow before, but now you don't. So the investors are saying, we're out of here, right? We want to get rid of this property, or maybe they are being foreclosed upon, depending on the scheme of things. There's always opportunities though, right? A lot of buildings in the States are mismanaged, right? They don't have professional management. They don't have the things that shared does, right? They don't have all these things. So it's really easy to turn over a property, just needs time and money. But maybe they don't have enough, right? So they have to get rid of their property. But that's what's happening in the States for commercial.
It's funny. I just googled CMBS loans, and the third article is CMBS delinquencies soar, and the article is only 22 hours old. I'll have a look at it later.
That's right. That's right. So that's why some of those lenders are scaling back their loan to value to minimize risks on future loans. Obviously, if it's an existing loan, there's nothing they can do.
Right. Oh, just briefly, delinquencies have jumped just under 1%, 98 basis points. So, doesn't sound like the end of the world.
No, it's not huge.
Delinquency rate is up 1%.
Yeah. But still, I mean, it's still a thing, right? And it is what the banks are concerned about.
Right. Well, again, like it's no different than here in Canada. Like a lot of people got squeezed by rates, like over leverage,
Yeah.
variable rates, and uh, like it was just in the news, just I think this week or last week about the Northern Ontario investors, or things are just wrapping up now. A lot of the a lot of the properties have been sold off. The rest are being sold.
Yeah.
Yeah,
It's
very
crazy.
cool. Yeah, it's totally crazy.
But
And-
that's the
Oh, go
point
ahead.
of doing this, right? So we can educate people and then you can make smarter decisions when you do invest.
Sorry. Now, what are Canadian investors asking these days? Actually, you mentioned it before we were recording. You mentioned how the opportunity is in commercial in Canada. Can you elaborate on that?
Yeah, we're seeing a big flow to that. I mean, there's a couple different things. So, and who knows with politics what's going to happen. But let's say, Erwin, you and I decide we want to invest and we build an apartment building in Ottawa. Whatever. Let's just say we do it in Ottawa.
Hmm.
Because it's a new building, there's no rent control. So that is one of the benefits of building a multifamily property is that you eliminate rent control, which is great because we know in Ontario that sucks. So that's a benefit. You still have tribunal issues that I know Ontario is working through, but there's other provinces like Alberta and BC. They're more landlord friendly, and investors are going there. So you don't necessarily have to buy or build new. It can be resale, but with multifamily, right? Depending on the deal, like, so regular CMHC financing on apartment buildings, you can go to 85% loan to value. So you're only putting 15% down on a building, which is awesome. You can get that down to as low as 5% down, as long as we're using the MLI Select program, and we've got 100 points. So we have to have a large affordability aspect. So many of the units have to be low income, and then the building has to be green and it has to be accessible. And then you get these points, right? And then that determines your loan to value. So imagine buying, $5 million apartment building with just 5% down. It's awesome, right? It's
Mhm,
incredible.
mhm,
That's the same as somebody buying, $1.1 million home with going conventional with 20% down, right? It's the same. So um, that creates a lot of opportunities, but then you get longer amortizations. When you buy apartment buildings, you can get up to 50 years, which is just massive. So then you've got that really strong cash flow. Um, so that's kind of where we're seeing really the numbers still make sense in Canada. We both know the days of buying single family houses over here, sometimes even duplexes. It just doesn't work, right? The numbers just don't support it.
mhm.
Um, and then, yeah, like I've seen like this deal came across my desk. It was 4 units for like 2.2 million. Like, how do you cash flow with that? Do you know what I mean? Like you just can't. But for 2.2 million, you could buy a 20 plus unit in Alberta. Do you know what I mean? So like in comparison, um, night and day difference for the multifamily,
Mhm.
which reminds me of the States, because in the States, you can still make money on a single family property, right? So when you're looking at it, not dollars in your bank account, but when you look at it as a ratio, so how much rent is left over after your expenses, you're getting the same ratio as a whole apartment building. So like the US makes a lot of sense to me.
Now, with the CMHC MLI Select program that you're referring to for commercial, is for the investor, is their intention to stay in that mortgage for 50 years?
No, I mean,
Or do they have to, is there terms, or is like a 5-year term or 10-year term? Is there a time that they have to renew or anything like that?
yeah, you can get a 5 or 10 year term. Okay. But the you have to keep the low rent units. You have to keep them for 10 years. So what we're seeing the investors do or talk about doing, we haven't seen it happen because that's going to be in the future. But we're seeing them buy these properties. They're, renting it out and all that good stuff. And then their goal is to sell in 5 or 10 years, right? Because the building will go up, they can raise the rents on the other units. And in commercial, the more rent that you can charge, the higher the value of the property.
Hmm.
And they're just selling it off with assumable mortgages through CMHC. So,
Oh, sorry. So the mortgage can be assumed. Okay.
yeah, depending, right? The investor has to have experience and certain net worth requirements. It's not just like it's whatever, but yeah, they can be.
Hmm. Is there much history behind this yet? Do we know who's buying these? Are these like regular people that would buy to for 'cause I'm just thinking exit plan for the investor developer. Are they selling to another regular everyday investor, or are they selling to like a private equity?
I think all the above. All the above. I mean, we don't see the private equity deals because they've got their own money. They don't need it.
Hmm.
Right? They raise it. So they don't need mortgages, many of them. But um, it's all the above, right? There's REITs that buy these buildings when they're turned over. It's everything.
Hmm.
We're primarily working with the end user, right? The individual investor or group of investors or actual developers. We have a
Hmm.
couple developers on our team, like three actually. We have three developers. And that's all they're doing is like building properties, and that's what they do, right? So we kind of have that knowledge behind the scenes to help our clients as well.
Hmm.
Uh, but yeah, it's everyone's buying them that can, because they're easy to qualify. You need a little bit of experience, but with the low down payment requirements, it's pretty easy.
Uh, f- so for those who aren't familiar, like how much money does one need to bring to the table? Because we're still talking about development. Like there's still lead times to get to execute on the development. Like how long do you think this will take, and like how much money should someone bring to the table, just roughly?
Well, honestly, it depends on the deal. If you're not,
Well, if it's in Ottawa, it's going to be expensive.
yeah,
So-
for sure. I just, if it's your first deal, I don't know if I would develop a property. Maybe you can
okay, okay.
find a
So
builder
this
or
is not for
developer.
beginners.
Yeah, like I would buy you could still buy a property that's being developed, but buy it completed. You don't necessarily want to go through the development phases. Because
Just
there's projects,
beginners.
yeah, I mean there's projects that get held up. There's different things like we're working on one right now, and the lender has a condition that this developer has to satisfy before they can sell off their lots. So this is an individual that's like lots for subdivision. But the investor needs to pull out money out of the property to do that, right? Because they need that capital or raise it. Um, but they can't sell the lots until they meet that condition, but you can't get the money because the city hasn't fully approved it because you haven't met that condition. So it's like, you know what I mean? It's really hard sometimes. Where if you're buying it like turnkey, the developer works through all those headaches. So generally on construction, we're seeing 12 to 18 months for a
Mhm.
property. Um, so if you have the builder finance it and build it all, it's going to cost you a little bit more. But the beauty of it is right up front, you get to see the numbers, and then CMHC knows exactly what the property is working with. So you know that you're approved. You know what I mean? You get that approval right up front. So it's really nice from that standpoint. So you're not second guessing. You know what your approval is, and you just go from there.
And is MLI Select only available to the original investor developer, or can the
No, but it's
person take
best
into
on new
the original?
properties. It's best on new properties because if you try to buy an existing building, you might qualify for part of the MLI Select program because the rents could be low, right? And that's part of the requirement is to have low rents on, depending on how many points you get, it determines and tells you how many units, like what percentage of units you have to have below market rents. But then you're still not going to score 100, which is why you need to maximize the program because we have to deal with the greenness of the building, right? Is there a brand new boiler, brand new windows? How's the air sealing of the building? What's the insulation like, right? Like those are things that you can't take care of before you take possession, as well as accessibility things, right? Like what if it's not wheelchair friendly? Do you know what I mean? I mean, every building is as far as like getting into the building, but like what if they don't have wide door openings for those units, or the bathroom's too small that a wheelchair doesn't fit in there, and things like that happen. So what clients do is they get a bridge loan. So it's a temporary loan so they can renovate the property, upgrade it, do whatever they need to do, and then they switch to CMHC financing. So that's how we do that.
All right, so complicated but worth it.
I think it's definitely worth it. We're seeing clients make millions per deal, like based on especially turning over properties. That's where you can really force the appreciation. So we're seeing people come out with millions just from one deal, right? So it's absolutely worth it, but it's harder for sure.
I mean, just to reiterate, Alberta is easier to operate a real estate business because there's no rent control and the landlord basically has all the rights. Is that about
Yeah.
right?
Yeah, sounds about right.
Which actually leads us, which good segue into the U.S. For Canadians looking at U.S. properties, what does lending look like? So before you and I were recording, I find it's very common. Well, not so much for you, but for me, I still get the at least once, twice a week, where a Canadian investor will say, "Do I have to buy the U.S. property all cash?" Because typically their context is of recreational properties, as in like snowbirds who occupy their property and they don't rent it out at all. And my understanding is those folks do typically have to come out all cash. There is no mortgage options for them. What do you have to say about that?
Yeah, so we can finance them. For our product is geared towards rentals, but if it's a recreational use property, the lenders will finance it. I just disclose to the lender, be like, hey, client's going to live in it a couple months a year. They're going to rent it the rest. And depending on the lender, they'll all have their own unique process on how they calculate all of that.
Hmm.
So yeah, you're right. Before this call, we are talking about it, and the very first one of these deals that I've done, the lender said, "Well, you know what? We can't guarantee that the client is going to stay in this property, so we're just going to use market rents for the whole year. And if they come in for whatever, a month, 1 year, great. If it's 6 months, another year, whatever, we're fine with it." So that's what the lender did. Now every lender is different, but we can do it. We can get financing. Financing is up to 75%, depending on the loan size. So one of the major shifts that I'm seeing is the lenders are pushing away from those smaller loans. Um, and if you listen to our previous episode, we would have talked about how the lenders sell the debts. None of the lenders keep the loan on the books; they all sell it. And those small loans, it's just not something that they want to do or want to carry. So they are trying to get rid of them. We had one lender that would do loans as low as 75. The next week they changed it to 150 within 1 week. We still can do the smaller loans, but I'm not saying that that's going away, but I'm saying lenders are backing away from that. So the existing lenders that are there, what I think that we're going to see is much higher pricing. Because think about it, Erwin, say you're an investor, right? And you're looking for a bigger loan, but a smaller loan hits your desk and you're willing to buy it because you want to make the money on the interest until the loan comes due. Well, if it's a really small loan, you're not going to be as interested in it. But if it's a small loan, but a really high interest rate, that might interest you, right? So that's what's happening is on those small loans, the investors, they're getting priced much higher for the small loans. So you just want to watch out for that. And when I say small, yeah, I mean between 100 to 150 or below, like below 150. If it's below 150, it is going to be considered a small loan. You're not going to be priced as aggressively. And above that, you can get some really good pricing.
Now, just to reiterate, because not everyone listens to the show, they don't catch every episode. Can you explain what is debt service coverage ratio mortgages in the U.S.? Well, actually, let's take a step back. Uh, how does investor financing work in the U.S. for a Canadian? Because pretty much everyone that listens to the show is Canadian. So how do they get a mortgage on an investment property in the States?
So it's literally based on the property. That's it. And it's so funny to me because still, even to this day, and just really preaching it, people still they have the hardest time wrapping their mind around it, right? They're used to Canada where it's like, give me your credit score, give me your income, let me decide, right? It's not like that. Um, it's literally show me the address of the property. And here's what I tell them. Here's what I ask clients for. The full address of the property, the purchase price, the rental income of the property taxes, home insurance, and if it's in a gated community or it's a townhouse or condo, then we need the HOA fee. So what the homeowners association fee is.
Yeah, our version
Just
of
based
condo
on
fee.
that.
Yeah.
Yeah, just based on that, we can run the numbers. We determine how strong the property is, which helps with the rates, right? The stronger it is, the lower the rate. And then we tell you if you're approved or not. It's that simple. It's that simple.
How's this compared to, like, again, you've processed thousands of investor mortgages in Canada. How does that compare?
Well, it is actually slightly similar to the commercial world. So commercial, it's the equivalent of DSCR in the States, but in Canada, they're still wanting to check your credit. They're still wanting to have you personally guarantee the loan. Um, Debt ratios don't really matter on commercial, right? So if you've got like lots of loans and car loans in Canada, it doesn't matter. So that's kind of good. So it's similar, but over there, like I said, it's just literally those numbers. They don't care about anything personal and they move forward.
Mhm.
So no, actually, there is one difference. So in the States, I priced one last night actually. The property does not cover itself at all. It's actually in the negative. And they will still do those. They'll still do negative loans. Um, what they do is they require the investor put a little bit more down. So it was 35% down. Actually, sorry, no. We had a lender that would do 30% down. So 30 was the minimum, where like I said earlier, 25 is the normal minimum. So that's how they get there. You put a little bit more down and then they're willing to do it. But in Canada on commercial, if the property does not cover itself, they scale back the lending to the point where it does cover itself.
Oh,
So Canada, even though we're at 30 in the States, you might be at 50% down in Canada. Same numbers.
right. And we went through that exercise in our last YouTube we did together.
Yes.
I was literally speaking to a broker in Toronto who specializes on condos, and she said the norm is negative $1,500 a month on the condo. So yeah, how much do you have to put down in order to break even on that?
Yeah, that's exciting. Yeah, let's just get into debt because it might go up, right? It might go up in value.
Yeah, it's so scary.
But that's how some investors invest, right? So if you want cash flow, though, that's what we're talking about here. That's what you're really going to get.
Now, say, okay, so some Canadian investors are used to deploying more money at once. So, for example, a Toronto condo usually starts around somewhere around $600,000. Say I want to deploy 600,000 on. Say I want to deploy a million. So let's go easy million, a million Canadian dollars. Say I want to deploy $1 million right away.
Yep.
Right. Is it hard for you to get mortgages because our properties in the States are way cheaper. My clients are buying between the house is 90,000 to 265. So with a million Canadian, I can probably buy 3, 4, 5, a variety of houses. How is that for you to get mortgages for? Say they can source them easily, because say they're a share client, so they can source them pretty easily, all within a few months. Is that an issue for you mortgage wise?
No. No, it's super easy. Yeah, it's super easy. No, it's easy. Yeah. I wish I had more to add to your question, but it's not a problem.
Okay, so flip side. Say I want to buy 2 negative cash flow condos in Canada. How easy is that? It's still going to be negative $1,500 a month each.
No. So what we're going to need to see is that you have personal income to cover those losses.
Yeah. So I need more than $3,000 a month of my own personal income to cover those losses.
Yeah.
For tax money.
You probably need 6,000. So if you have a $3,000 income loss, you need at least 6,000 of personal income per month just to be able to cover them. And that's not even including your other debts, like your primary home, if you have a car loan, credit card debts, all that stuff.
Right.
But primarily, because the rents, the losses, right? We have to be under 50% debt ratios to work with most A lenders. And I'm not talking with CMHC, because CMHC stuff on single family is 44% debt ratios. But when you're at 20% down payment in Canada, the banks in that, they'll usually go to 50% total debt service ratio. Right. So you take what your loss is, right, and double it. So you get that 50% ratio. So you need $6,000 a month just to be able to buy those 2 properties.
So it sounds like someone would max out pretty quickly. So that's actually a good segue to my next question. What's working out for Canadian investors who are maxed out?
Yeah, so
assume credit. Oh, they still need money. They still need money for down payments.
There's a couple things. So I'm doing this right now for an investor. He is in Alberta, and so the one property he has, it covers very, very nicely. So what we're doing is we're shifting that property from his personal name into a corporation.
Oh.
So then the mortgage will not show up on his personal, and then we can use other lenders that don't care. So some lenders, and I'm referring to Canada, if you have properties in your corp, they don't want to see it on the application. Some of them do, right? So it depends on who you're working with. That's why working with a broker who understands this is important. But so that's what we're doing. So we're removing the one from his file altogether, which will clear up his debt ratios. And then the other one, it's negative cash flow, just like what we're talking about here. So I can't shift that to commercial because it's negative, and the amount of money that he can receive on it is about $100,000 less than what he owes. So he's got to stick with the regular lenders where they're using his income. So what I've done there, just to illustrate the complexity of what this looks like in Canada, is we're refinancing his loan, but we're not giving him any money. He's not getting a single dollar out, but we're re-extending his maximum amortization to 30 years by refinancing it. So we're changing lenders. his rate will be slightly better because he bought at the peak of the high rates. So it'll come down, I think 1.5%, and then we'll give him the 30 years. So that'll that'll reduce his negative. He's still going to be negative, but it'll reduce it a bit. But both of those things combined free up his debt ratios. So he's still at around 44 to 45% debt ratios, which means it's not enough. Like he still needs to do more. It's good enough that he can, work on some basic stuff that he wants to do, but it's still not strong enough that he could buy a ton of other properties. You know what I mean? So that's the challenge. And you flip that to the States and just property covers itself, approved.
Yeah.
Buy your next
I
one.
was,
Oh,
I was
it
gonna
covers
say,
itself too, approved.
I was gonna say he doesn't have to do all his financial jujitsu if his investments were just in the States.
That's it. And when you consider it, like he's talking to his accountant, right? It's a sale, right? It's counting as a sale going from his personal name to his corp. So they're trying to avoid capital gains and all that other stuff. And it's like,
Yeah, land transfer
but
tax. Yeah,
but it's important to him. Like that's what he has to do to kind of make ends meet on the Canadian side of things.
yeah.
And so it's not, yeah, it's tough.
Because it happened to me as well when I wanted to buy when we were trying to buy our current home. It was a step up in price point, so it'd also be a bigger mortgage. But our portfolio was hindering our personal ability, our personal credit ability to get more credit to move
Yeah.
into the home that we currently love. We loved our last home too, but we loved our new home better. And if I and hindsight being 2020, I wish I started in the States much earlier. If I wish I focused there, I would have a lot less gray hair because it'd be easier to scale, it'd be easier to manage, and all those wonderful things, earning U.S. dollars. But it would not have infringed on my personal credit, which I think is a benefit to all Canadians. You want to protect your personal credit so that, like, imagine telling your spouse, "Sorry, honey, that duplex we bought, now we can't buy that dream home you wanted
Yeah.
because our credit's all taken up."
Yeah, it's terrible. It's terrible. And in the States, it does not impact you at all. Now, I don't know if you saw this, but just to touch on this,
Yeah.
because we follow a lot of the same people online, but I saw yesterday this crazy cool graphic, which was showing like the past 50 years of the real estate market. Every single year there was appreciation except for 7 of the years. Did you see that one?
Was that Toronto or Canada or is that U.S.?
It was US. It was in US.
Oh,
Someone shared it and I saw it. But I was really impressed because just when you consider, and I mean, I know this is off, me and you just discussing this, but when you consider that you can buy a beautiful house in the States for 150 to 200,000 and know that it had appreciation the past 43 out of the 50 years, right? Like it is just so cheap. Like it's crazy.
yeah, it's cheap.
Crazy.
But I was discussing with another real estate friend about we are talking about price appreciation, and I said, let's remove price appreciation for real estate. Let's just talk about inflation, because it's
Mhm.
basically guaranteed over the long term,
Yep.
right? Especially the direction we're going now with tariffs. There's basically no option but for inflation. And let me just do a quick screen share so at least the folks on YouTube can have a look. Hopefully, I get the right screen this time. But yeah, I used to show this chart all the time. For the folks who are listening, if you just Google visual capitalists, growth of 100 by asset class, growth of 100 means growth of $100, then it's one of my favorite charts when I used to explain to people. And it says so on the graphs that U.S. home prices have gone up 5.5% on average annually over a 53-year period from 1970 to 2023. So a 53-year period, average houses have gone up 5.5% on average, and that is sourced from the Case-Shiller Home Price Index, sourced from NYU Stern. So yeah, and so we can talk about price appreciation, but put more simply from an economist perspective, it's inflation. And have we ever had deflation in real estate? In a place where population is growing.
Yeah,
Like we only
exactly.
see deflation, housing price deflation in areas where populations are decreasing. So if you
Yeah.
just If you just buy in a place where population's increasing, you're pretty much guaranteed inflation.
That's it. And that's a cool chart. I seen one that was similar when I used to work at the bank. It was called an index chart. I don't know if you've seen those. So it's the same thing, but it shows you the growth of 10,000 and it goes over that same span. And then it compares real estate, all the other asset classes. And I would have some clients say to me, they're like, well, stocks outperform. So why would I buy real estate when I can buy stocks? And I'm like, okay, well, of that $10,000 initial right cost, stocks you're paying $10,000. Where real estate, right, you're paying 20% down in Canada and getting the balance leveraged. Do you know what I mean? So when you look at the returns that way, where you're putting in 1/5 of the money or a quarter, right? If you're investing in the States, I think that extends your returns, right? Because you're putting in a quarter to a fifth of the capital needed that you would have for stocks. So I just always like sharing that perspective because a lot of investors forget that real estate is leveraged, that the tenant pays down the debt and not you. And I think that's an important point to consider.
Yeah, and I get way more tax advantages owning real estate than I do a stock.
Yeah.
I get depreciation. I can use Smith
Yeah.
maneuver. Yeah, and then I can refinance. After 3, 5, 7 years, I can refinance that original property and buy a second one. And then
1031
basically double this.
exchange.
Yeah, 1031 exchange, but that's the Americans.
Yeah.
but when I double the size, triple, quadruple, 10 times the size of my portfolio just through time, just by refinancing the original properties, then now I've 10x my portfolio, and now I'm making returns based on a much larger portfolio after just one initial investment. So
That's right. And a lot of investors are using refinancing as their income. Do you know what I mean? Because that's tax free.
it's tax free.
Yeah.
All right. Very common question. I should have asked this sooner. Fixed or variable?
Honestly, right now I say variable. Because variable, we know that they want to adjust, and that's what they can control. The fixed they cannot control because it's tied to the overall markets. So when we need stimulus, right? If the economy is weak or whatever, they stimulate by lowering the rates. So I'm saying variable right now. And then if you're concerned, if you're someone that hates variable, right? There's two types of variable, and people don't realize this. There's the adjustable rate one. So this is the one that people are scared of. They're scared that if rates go higher, their payment goes higher. Okay. So that's what happens with adjustable rates is your payment goes up, but if rates go down, your payment goes down. But if you get the regular variable, your payment is fixed. So if rates go down, if they go up a little bit, you still have payment stability. Now, obviously, you want to be very careful because if it's before, like during COVID, when the rates went up really high, and if you had that fixed variable payment, then you'd be in a negative amortization because the rates went up so high that now your actual payment is not covering what it should. So you want to be careful with that. And you can readjust your payments at any time. So to give you that payment, that budgeting, safety net, the variable rate mortgages are the way to go. But then again, if you're someone who hates variable, once you think it's at its lowest, you can lock in at whatever rates are at that time. So you don't have to stay with variable forever. It's just a tool to get you to where you want to be.
Now let's talk about the States because we're typically dealing with a 30-year mortgage. Very common question I get is, well, we're near historic highs already for interest rates in the States. What are the fees like? Say so. For example, our share clients were recommending that they in probably roughly 3 years' time, interest rates will bottom. Again, we're just guessing, but we're forecasting and underwriting to refinance in 3 years. What does that look like? Very common question I get is there a penalty for early breakage of mortgage in the States?
Well, there is, unless you set it up so there's not. So you can select. So by default, a mortgage has a 5-year penalty. So within 5 years, you break the loan, there's going to be a penalty. But after that 5 years, there's no penalty. So you're open. So you can do whatever you want. But if you're dead set and you know you're refinancing on 3 years, we can change the regular 5-year penalty to a 3-year penalty. And then you can refinance 2 years earlier without that penalty, but there will be a slight premium on the interest rate. So you got to keep that in mind. But that's exactly like we consider all those options. Can I share an example of kind of what we've done? So I have a client who's buying 2 eightplexes right now, and in the States. So each one is valued at 750, but he's buying it from a wholesaler for 550 each. He's going to have 16 units for 1.1 million, which is crazy. So what we've suggested to him is go with the 1 year, so pay the premium, and then after 1 year, we can refinance at the new value. Because when you buy, it is kind of like Canada where your appraisal value could be higher, but the lending will be based on your purchase price. So the client can't access that equity instantaneously. But we're having him go with the 1 year, and then he's going to refinance afterwards, pull all of his down payment out. He's going to get it all out. And he's actually going to get better rates because his loan size will be bigger. So we can get him into those CMBS loans that we were talking about earlier, because those are cheaper. Those are low sixes. Where DSCR I'm finding is like high sixes to mid sevens. Like that's like a really good rate, is in that range. But the CMBS is cheaper. So that's what we're doing with him, right? So we're specifically getting him a 1 year. It's priced much higher. I think he's going to be at like 8.75 actually. So it's higher, but it's worth it. So we can pull out his money, move forward, get the better rates in a year. So it's all about the investor strategy and what they're doing.
Speaking of investor strategy, so one of my favorite things to tell people is don't listen to what people are selling. Listen to what they're actually investing in. So Scott, what's your next investment looking like?
Well, I sent Dimitri on your team an eightplex that I wanted to see if you guys could manage, and it seems like you guys can, which is incredible. So yeah, I'm looking for something smaller, multifamily in the States, just like Canada. We got to start small. You can't just go buy a 50-unit apartment building because you need that experience. So most of the lenders, they don't count your Canadian experience. So when you're buying over there, you got to start off something smaller, and then you can build yourself up to bigger. So I'm looking, yeah, somewhere 8 to 12 units personally. I'm not opposed in the slightest to a great single family property or duplex. Like I would totally do that all day. In fact, I have a bunch of investors that want to partner with us. So I think I'm going to be targeting those smaller properties for them, kind of like a JV deal, right? Because they want to partner, but they don't want to get their hands, involved. They just want to give the money.
And I
So,
don't know how easy this is
yeah.
in the
So
States.
I'm looking at some of those
These are
smaller ones.
Canadians, I'm assuming.
Yeah, they're Canadian.
Okay, yeah,
Yeah.
yeah.
So yeah, so there will be smaller ones because of those partnerships, but like me myself, I do want like something a little bigger.
Mhm. And can you share which state?
Well, the eightplex that I looked at's in Maine actually. So Maine is a blue state, so you want to be careful. But the thing is with Maine is it's kind of in the middle. Even though it's a blue state, the landlord rules are fair. There's nothing crazy and outrageous. You can still get people out if they don't pay rent in 4 to 6 weeks. Maine is more about you got to give proper notice to things. So I think that's where they're really like sticklers to the landlords is giving that proper notice. But I'm used to that anyways from Canada. So for me, that doesn't push me away.
Right.
But my family's there and that's where I was born. And I know some of the towns and
Mhm,
I've watched the real estate there ever since I got into lending. So I can see what some of these markets are doing.
mhm.
The town I was born in actually has the fastest depreciation out of any of the cities in Maine. So that's kind of where I'm looking at this property. So it's just whatever. But I'm open to anywhere as long as there's good fundamentals. Like this particular part of Maine is the Section 8 hub of Maine. So if somebody gets legal status, they actually send them to Maine to get started. So from Section 8 standpoint, it's a rock star location.
Maine's nice. I did a cruise ship stop in Portland, Maine. Did,
Portland's awesome. I love
did some
Portland.
lobster fishing.
Portland's my favorite. It's kind of like a small mountain
Uh-huh.
with the city built up around it.
Mhm.
So certain parts of the city, you're up on a hill and you can look down and see all the houses and commercial properties and the ocean. So
Mhm.
it's cool. But yeah, Maine is nice. It reminds me of like camping.
So Scott, you mentioned non-payment of rent. You think about 4 to 6 weeks for the tenant to be evicted. Is that what
For
you're
me,
saying? For me.
that's where it is for me. Yeah.
Now, what's your experience in Ontario?
Oh my goodness. Never. Never. When can the tenant be evicted? Never. No, honestly, it's like 8 to 9 months is what we're hearing. I did hear it was like working on 6 months, depending on the reason for why they need to evict. But still, it shouldn't be that long. It still
Yeah,
should not be that long.
it should not be that long. It's a big difference in how much you're out of pocket, how much your losses are
Yeah,
between 5 to 9 months, year or more versus 4 to 6 weeks. Because again, in the States, you're allowed to take a security deposit, so
absolutely.
you're actually not out that much if it takes you 4 to 6 weeks to evict.
Yep. And when you consider like when I started investing, it was 4 to 6 weeks in Canada to kick someone out. Maybe 8 weeks. Like maybe sometimes if the tribunal was busy, it was 8 weeks. But like that's what it used to be. Do you know what I mean? So
Mhm.
that's all I want back is just bring that back. But
So we have some rapid fire questions.
sure.
Best lender or product for first time investor?
It depends what you want to do. Are we talking Canada or the States?
Let's do both. What product or mortgage
Okay.
should a first time investor get in Canada?
If you're in Canada and you're flipping a property, I recommend Calverts that cover
Right.
Alberta and Ontario. You only need 20K down and you got to cover your own rentals, but they'll fund the whole deal for you with just 20K down. You could buy $1 million home. You just need 20K down. Okay. So Calvert in Canada is the way to go. In the States, I would
Just
say,
run your numbers carefully, because if you're a beginner, we're talking about here.
well, and that's the thing. Calvert will not approve the loan unless you've got cash flow. They will not.
Right, right.
Like they'll decline the deal and say, this one doesn't make sense. Go buy another. So they're not actually declining the borrower. They're declining the property and they have their own internal appraisal system and everything. So it's, I don't want to say it's fail proof, but they put in a lot of different contingencies that other lenders don't even look at.
Mhm, mhm.
So
Their
that's
default
cool.
rate's quite low. I've talked to them many times.
Yeah,
So if they're willing to lend it, hopefully you got all your ship in order.
that's right. So that's what I'd recommend there. If it's a buy and hold in Canada,
Oh, sorry. Actually, just paint let's finish painting the picture for the listener. What do you think that deal looks like? Uh, if a beginner's flipping a property.
well, it depends. So there's a cash flow analysis, and if anybody reaches out to me from listening to the show, I'll send it to you. And you put in like what your renovation costs are, even factors in real estate commissions and broker fees and all that good stuff.
Mhm,
And then it calculates how long it will take you to, well, you've got to input it. But based on your inputs, it'll tell you, okay, you said to me it's going to be 4 months to you turn over the property. Here's the carrying cost for 4 months. Here's the estimated profits based on the after repair value that you think that you can sell it for. And
mhm,
it tells you if there's profit in the deal.
mhm, mhm.
And if there's profit, then the lender will approve you. But if there's not, they won't.
Okay, so if you get an example for a very active investor, can I get an example for a passive investor?
With Calvert, or
No,
you
no,
mean
just in general.
lender?
Just in general, what's a passive opportunity for, what's
Well,
the best lender or product for a passive first-time investor?
so it totally depends on the investor. But what I will say is do not just go to your bank. We've talked about this on, many different things, but I'll give you an example here. So there's a green bank that'll do five mortgages for you. And that's it. So it doesn't matter if you get those mortgages somewhere else or you get them at the green bank first. The red bank will do 5 properties for you from them lending to you. Okay. They don't care. They'll only do 5. But if we go to the red bank first, then the green bank will say no to you because you already have 5. Even though they're at a different bank, they're going to say no because you're at the cap. Right. But if we optimize the investor and send them to the right lender in the right order, The correct order in this specific case would be do the green bank first because they'll do 5, and then go to the red bank after because they'll do 5 with them, but they don't have a global cap on how many you can have in total. So now you've done 10. Right. So I think that's the thing, is speak to an investor focused lender who could optimize the pathway because it is different per client. And then that will help you to maximize your purchases.
Right. And the strategy's shifted quite a few times over the years.
Yeah, the lender always changes. Yeah, we had one lender that would do 10 properties and they went down to 4, right? So they're 4. So we've got another one that's great that does 12, but I try to use them at the end. Like I'll max out all the other lenders. And then it's sort of the last A lender that'll do 12. And this is all residential. On commercial, it's unlimited. We can bring them there. But commercial, there's fees, right? So we're trying to get the investor the approvals without the fees. But if they've got to go commercial, then that's what we have to do.
Right. And you said commercial's unlimited, just like commercial in the States, which
That's
is also residential, including single family homes.
That's right. But when you get into that product, there's fees, right? Both countries, there's fees for this.
I don't really necessarily blame them because, like, in Canada, I'm used to seeing mortgages for hundreds and hundreds and more than $1 million. So the interest payments are quite large versus like a $100,000 mortgage. It's not that much money to be made on that. Exactly. It's the same amount of underwriting work.
The very same. Sometimes it's even more because the smaller deals, they get scrutinized more because the clientele, it's a stigma, but the lenders, right? If even in Canada, right? If you're buying something really small, they're going to screen that client more. Someone wants to buy a $10 million apartment building. They don't even look at the person. Like, it's crazy. And you think they're lending so much more, but that's how it works, right? The smaller deals get the scrutiny.
Right. Well, those smaller deals are luckily in lesser nice neighborhoods.
For sure. Lesser neighborhood. It could be all the borrower can afford, right? So it's like there's borrower risk there. And so you just never know.
All right. Best for ... scaling beyond 5 properties.
Like best way how to do it?
Sure. Both Canada and US.
Okay. Canada. What you want to do if you're just starting out is you want to buy the rental, but move into it. Do it for 5% down. Okay. You can do that 3 times, but you got to wait a year each at least. Okay. So I'd recommend that. Buy it, renovate it, upgrade it, right? Because what happens is the second you move out, the forced appreciation and the natural appreciation that the property receives, you want to mark what that value is at that point. So then down the road, if you sell or whatever, and there's capital gains, you can at least show the value you put into the property. But by moving from one property to the next, gets you 3 with small down payments. Then you can refinance those 3, pull out funds, and then keep buying essentially. And that is the exact strategy that I did. That's the exact way that I did. So that would be that. In the States, I mean, there's many different ways, but because of down payment requirements, even though they're 25%, the purchase prices is so small, right? So what we're seeing is a Canadian do 1 refinance in Canada, but they've got the capital to buy 4 or 5 over there based on that. So I would encourage that. But if you're starting from no money, then I would look at a potential fix and flip because those can have smaller down payments in the States. And then from there, right, take your appreciation and profits when you've sold and then start investing into other properties, maybe buy one, buy and hold, and then do another flip, and then take the capital from the flips to buy a permanent property, and then you get to 5. I know it sounds easy, but it's all possible.
Most overlooked mistake you're seeing right now from borrowers?
Bad underwriting, bad research of their team, right? Like if they're counting on a realtor to give them this data that they need to make a decision.
So you presented bad underwriting.
Yeah. And then, even unknowns, like for an example, and I'm just picking on, North Carolina, but the second that property is a rental property, they're going to 4 times the property tax on you. So if you bought it and it just covers, and then they discover it's a rental property and your taxes go up 4 times, it might not cover, right? And that might be something that even your realtor gave you the proper underwriting in the beginning, but without knowing those little nuances, it costs you down the road. So you want to think about, what other questions am I not asking here? Or how can I creatively get additional information from the people or the team that I'm speaking to?
Mm-hmm. Now you've looked at a lot of underwriting from Share. How is the underwriting from Share?
Like I think it's awesome. You guys underwrite things so much. Like you include all these things that the lenders don't even look at, but it's awesome because it's better for the investor. So you're taking those investors that we just said their problems, what their problems were, and you're solving them essentially.
Yeah, I find one big miss is often I show Canadian investors, we have for example, on our underwriting at Share, we have a line for bad debt, as in like non-payment of rent. And then I'll ask them, what do you use on your own underwriting for an Ontario property, for example, or BC, Quebec? What do you use for bad debt? Almost nobody has an answer.
Yeah, because they're not doing it.
They're not doing it. Like at a minimum, you have to use 4% for bad debt because that's the cost of bad debt insurance.
And you're also factoring vacancy on top of bad debt.
Yes,
That's
that's the way
crazy.
it should be.
You know what I mean? That's awesome. That's really good.
Yeah.
That's
And then
really
you've seen, and then actually one of the last deals that we sent to you, it was for an already tenanted property, right?
good.
Which I love because, like, I hate vacancy. Vacancy's poison, poison for a portfolio. Versus, like, our last client in the U.S., they bought a already renovated property with the tenant already living there. So then we can screen the tenant already if they're in a tariff or AI risk career, and before deciding to buy the property or not. Like, and then you got us the mortgage. It's brilliant.
Yeah, absolutely.
All right. Again, it's April 15th. The Bank of Canada meets tomorrow, so we don't know everything, but it's April 15th. If you have to give investors one tip to prepare for the next wave of opportunity, what would it be?
The next wave, honestly, just don't wait. There's, there's so many people that try to time the market, and I've done this for so many years, Irwin, and year over year over year, everyone said Toronto's going to crash, Toronto's going to crash, Toronto's going to crash. It did cool, it did correct a little bit, never crashed. Do you know what I mean? It never ever did. So if you're one of those people that are thinking, oh, it's going to crash, the sky's falling down, you're missing opportunities. There is a buying season, regardless of what's going on in the world, economy, whatever. There's always opportunities if you know how to look. And again, it comes back to having the proper team as well. So I think that's it. Don't wait. Right? What is the saying? It's better to plant the tree, what is it, 20 years ago? And the second best time is today.
Hmm.
Right? So don't wait.
I heard another one just recently. I'm listening to Atomic Habits by James Clear, and he talks about how it's proven basically that action uh, always gets you better results than research and just going through the motions.
Yeah.
Action is so even if you make a mistake, you'll have learned something and you'll be able to readjust faster than the person who just keeps doing research. I'm kind of like both. I've done some action. I've done a lot of spinning my tail.
Yeah. And I think that's the thing. There's a lot of people that do, right? And then they do that for so long that then they just don't even take action. Do you know what I mean? They kind of just give up. And I think that's the worst thing that you can do. I mean, having a rental portfolio and all these things, right? Like that's helped me get through COVID and all this other stuff that other people, right? They just couldn't. So it's like these assets can help you in times that you don't even expect it, but you have to have them, right? To get that benefit. So,
You're just lucky, Scott.
well, you too.
Yeah, you're lucky you're dual citizens, so you can have brokerages in both Canada and the US.
That's true. That is true. I am lucky, but I'll tell you one thing. Crossing into the States has always been easy for me because just whatever, but I've got a US passport. So whenever I come to Canada, I always get the hardest time. So I'll share that with you. So it might seem lucky on the surface, but I always get a hard time coming back.
Even showing your Canadian passport?
I don't have a Canadian one. I just have the US one
Oh,
because I technically don't need both. I mean, I could get both, but I don't need it. I just need one.
hmm, fascinating. All right,
Yeah.
Scott. Final thoughts. Final thoughts for the listener. Anything you want to say that without me prompting you? Nothing.
No, I really believe it's a great time to buy. I mean, you see Canada lowering the rates. You see the stuff with the tariffs and stuff kind of cooling our economy a bit. And that's when it's a good time to buy. Trump's doing everything that he can because he wants to force the Fed to lower the rates. So you've got lowering rates in both countries, which increases demand, right? So that's why it's good to get out there now. And then lastly, I would say, again, just your team. Always have the proper team. And I love what you guys are doing. And just to share this personally, and again, Erwin did not pay me to say this, but like knowing that you guys are potentially, and I'm saying potentially because it's not final, but knowing that you're getting into potentially more than single family properties means a lot to me, because what your product is and what you guys offer as a landlord, it got so hard for me to manage my portfolio, even though I have a property manager, but it's still very hands-on, and to do the mortgages, that I wanted to get rid of all my rentals at one point. Like one point I was like, I just want to quit and just do the mortgages, because it's like, I don't have time. But with what you guys are doing, it's completely hands-free, and I love that. So I do want to place properties that I buy even outside of share within the share envelope. And I know that's not out yet. It's a work in progress, but I'm looking forward to when that's a whole reality.
Just want to highlight part of your challenges are because your properties are in Ontario, so the tenants operate under the landlord tenant board.
Yes.
So Share does for listeners' benefit. Share does support 1 to 4 units as of today, and also you'll be one of our guest speakers on April 26th. We'll be talking both Canadian best practices. We'll be talking a lot about student rentals as well, which it'll be lovely that you're there because it's one of the more difficult asset classes to finance. And also our mutual friend Ryan Poole will be there as well, talking about Florida, because we want to talk about opportunity. Holy cow, if prices collapse down there.
Yeah.
Right.
Yeah.
And like you said, opportunity.
Good.
And like we were talking about opportunity, I just want to share my screen really quickly. Traders are currently forecasting 4 rate cuts this year to the U.S. Federal Reserve, so the U.S. interest rate. So rates are getting cheaper. We can only guess prices will go one way as rates get cheaper. So we're expecting rates in the States to be cut by at least a whole point within 8 months.
Which is awesome.
Yeah, which is great for the real estate investor, because that means better cash flow for the rest of us.
That's it. Plus you can buy down further, so you can get it even lower if you want. So I love it.
Yeah, and we'll talk more about it April 26th.
Awesome. Thank you, Erwin, for having me. I really appreciate it.
Thank you, Scott. All right, friends, that wraps up another episode of the Truth About Real Estate Investing show for Canadians. Hope you got as much out of this one as I did. Remember that whether you're just starting out or a seasoned investor, there's always something new to learn, and it's always about building that practical knowledge base that gets you closer to financial freedom. If you found value today, please do us a favor and leave us a review or a rating, share this episode with a friend, or better yet, join our community of real estate investors who are taking action and making moves. And hey, if there's a topic you want us to cover, or have there's a certain guest you'd like us to have on the show, drop me a line. My DMs are open on social media. Reply to this email that this have arrived on. I'm not hard to find. We're all about getting you the unfiltered truth to help you on your journey. Thanks again for tuning in, and we'll see you at the next episode. Until then, stay smart, stay curious, and keep building that future. Catch you later.